Good afternoon. Thanks for joining today's roundtable, the 2016 Middle Market Outlook, presented by the Deal and R. Donnelley. I'm Mark Aiello, Vice President General Manager for Venue, the virtual data room platform of R. Donnelley. During our discussion, you're welcome to submit your questions for the panel using the posting feature to the right of your browser, and if time allows, our panel will address them later in the hour. Right now, debt is cheap and private equity firms have plenty of dry powder, but the number of middle market PE deals globally in the first half of 2015 was largely unchanged from the same period last year, as valuations remain at high levels. We've seen 270 financial sponsor-related deals valued between $100 million and $1 billion, compared to 258 transactions in the same period last year, according to Dealogic. And overall transaction value is also holding steady, $94.5 billion in the first 6 months of this year, compared with $94.1 billion last year. Joining me to discuss the middle market outlook for 2016 are Mark Ute, Managing Partner at Clarion Capital, Tim Alexander, Managing Director at Harris Williams, and Michael Finelli, Partner of RSM's Transaction Advisory Services. Guys, thanks so much for joining. Looking forward to speaking with you today. So Tim, I'm going to ask you to kick us off first. So let's start with the general question. How would you characterize the overall middle market deal-making environment this year?
Yeah, Mark, I mean, I think you kind of stole my thunder a little bit in the intro. I think right now the deal market is very robust, or continues to be very robust. And I think you've got a lot of capital that are chasing deals, and I like to say that we are still in a supply and demand imbalance. Now, I think that's broadly speaking for the middle market. Now, deals that are over kind of 50 million of EBITDA, or companies 50 million of EBITDA, I think we've seen a little bit of pullback in terms of valuations as the debt markets have gotten a little bit more choppy on that upper end. But I think broadly speaking, we are still seeing premium valuations in the market. You know, we always get asked, how long is this going to last? And obviously, we don't have a crystal ball. Though I think the one thing we can say, it ain't going to get better. It's just a question of when will things kind of pull back.
Mike?
Agree. Highly competitive with the really good companies. For those really good companies that are going to market in more of an auction process, we're actually seeing a lot of pre-LOI diligence, which we hadn't really seen in the past. So multiple buyers being engaged to do some work during that part of the process. The other thing that we're seeing, and also due to the highly competitive nature, is an increase in sell-side due diligence, which again, we didn't really see that much of a couple years past. And it's not exactly the same as the vendor due diligence in Europe, but a substantial increase in this overall sell-side due diligence process because of the highly competitive nature and trying to best prepare these companies when they do go to market.
And Mark, what are you seeing from a private equity perspective? Sorry.
So I think that we probably believe that the market's a little less stable and robust than these two gentlemen do. The statistics that you were talking about really are for the first half of the year. And the best way to think about it and the effect of the recent volatility is almost to think about it like you have an apartment here in New York. And it's been a very hot market, and people who are selling generally get their price. So what happens in volatility is that the person who's selling thinks he should still get his price. And the person who's buying is saying, well, if this volatility winds up being a leg down in the market, then maybe it's not such a good idea for me to pay up. And I think you're going to see that dynamic play out over this quarter and next quarter, where sellers aren't going to be willing to take a price that's implied by the lower volatility. They'll wait a little bit to see. So I think activity will actually lighten up a bit over this quarter and next quarter.
And then to dig deeper into that volatility, Mike, I'll ask you to comment. What do you expect to see with the recent volatility that we have seen, as Mark cites? What do you expect to see over the remainder of this year and into next year?
Yeah, from our perspective, you know, there's been a lot of talk in the overall marketplace from a public markets perspective, from a China slowdown perspective. How is the retail general consumer going into the holiday season? We're hearing everything from a more global public markets perspective, but the things that we're seeing that we're a part of within the middle market, and especially within private equity, we're not seeing that slowdown. We're seeing the continued uptick. Even from last year. I know the data shows that's been pretty stable with last year. Well, I don't see anything in the near term from a more public market perspective that's going to slow things down over the next few quarters.
And Tim, are you seeing volatility impact?
Yeah, I mean, I think probably not as much on the upper end of the middle market. You know, maybe some around the debt, you know, in the debt markets, which has put some pressure on deal values. I think we look at our backlog, and it's very robust going into next year. But one thing I would agree with Mark, Ed, I haven't seen it yet, But I think once we do start seeing it, where there'll be a disconnect between buyers and sellers in terms of valuations. Sellers always lag buyers a little bit, and when that happens, there will be a period of time when you just have more broken deals.
Right, deals just won't get done. Okay. What deal multiples are you seeing, and where do you think they're headed, Mike?
Sure. It seems to be like 10x is the new normal in terms of deal multiples. Although I will say for Q3 2015, it did seem that the multiples did tick down a little bit in terms of the overall middle market marketplace. I think it was more like 8.5. And I think whether that was just a mix issue or more add-on activity, it's difficult to tell. But that coupled with a small change in interest rates, which I don't think will impact things dramatically, but a small impact in interest rates, as well as what Mark was saying in terms of the difference between buyer and seller and their views on valuation, I do think it has a tendency and a very good chance to, within 2016, to stay at that 8.5 level or to at least come down from that 10x being the new normal, at least in the near to medium term.
And Tim, what are you seeing with the new normal of 10x?
Yeah. I mean, I would agree with that. And I think looking at some of the public data, you've seen multiples come down. Within our shop, they've held a little bit more stable for sure. And I think anecdotally, when I look at my own particular deals, we are probably still seeing a turn to turn and a half premium relative to normalized levels. When we're advising our clients about the question that we always get is, should I sell now or should I sell later? We are advising people, look, if you're thinking about a year from now, you better model in about a turn contraction or maybe a turn and a half contraction. So offsetting whatever growth you think you can get, you have to really grow a lot to be able to offset a turn decline in the multiple.
And Mark, where do you think multiples are headed?
Well, I want to pick up on something that Tim said in answering the first question, which is this is really very much a two-tiered market. That premium properties, companies that are fully formed, institutional quality, growing quite nicely, those are continuing to hold their multiple, and I think that's where you're seeing the most overheated part of the market. What you see is the discount for it being a non-institutional company or where there's other questions that you have to diligence is, I think, probably a more dramatic drop-off now than you've seen over the last couple of years. So I think we also think that multiples are probably at their crest, although we hesitate to ever predict markets because let's just say our history hasn't been so great at that. But I do think we're clearly at the higher end of the range, and time is not on your side. I think it's already broken a little bit, as I said, for the smaller, less institutional deals, and I think that'll go sideways more.
Okay, thanks. Tim, which private equity firms have you seen be the most active in the middle market?
Yeah, I mean, I think, look, kind of the $1 billion plus firms, by definition, they're trying to put more money to work. They're going to be more active. And I think one of the trends that we're seeing is larger private equity funds moving down into the middle market. So then they have to actually, they have to do more deals to put the same amount of capital to work. So, the usual suspects of a Riverside, an Audax, an Odyssey, an HIG, a Platinum, those have all been guys that have been pretty active in our transactions.
And Mike, who are you seeing in terms of activity in the middle market?
Same, nothing really additional to add there because it's the same story. There's a lot of overarching middle market activity, but when you're talking about number of deals closed in a particular year, there's a common theme there, and it's the billion-dollar funds who still play in the core middle market or the lower middle market where they can churn out 30 to 40 deals in a year, and it's the same, the Audax, Riverside, Vista, HIG, et cetera, yeah.
Gotcha, thanks. So Mark, what trends are you seeing in terms of financing for these deals?
Well, we're actually pretty concerned about the financing markets looking forward. In many ways, this has been a market characterized by excess liquidity over the last several years, so you've been able to have something of an overheated credit market. But we see tremendous instability in this marketplace right now. If you look back over the last 10 to 15 years, the single continuing presence in the financing markets was GE, which broke up its business and sold it off in different pieces. And I'm certain that some of the buyers will do very well and there'll be a continuing presence. I think we can all probably agree that all the buyers of the pieces probably won't be as consistent a presence as GE was. So then you look around the marketplace and say, who is really committed to the middle market? And you see some problems. The banks are largely out of holding term loans. They'll compete really aggressively to hold a revolver, particularly if it's asset-backed. But the term loans themselves, they don't want to hold. So they're turning around and selling those term loans. In the middle market, they're selling them to BDCs. But that's both not efficient from a pricing standpoint, but the other problem is that BDCs need to take in capital to finance deals. And 2/3 of them are trading below book value where they cannot sell more equity to get more capital in. So the only thing they can do is take their interest payments and redeploy them. So there's a significant constraint on that part of the market. In the larger deals, you see that the term loans are largely sold to CLOs, who have been 55% of the business if you look over the last 12 months. And CLOs are going through a retching transition themselves where all of the managers are being forced to hold basically risk equal to 5% of their assets. So you see banks that own CLO businesses are deciding these aren't good assets, and the regulators are telling them that they're not good assets. And then you have independent CLO managers that were formed and were never capitalized. They were never intended to have a large capital base to hold risk. So those people either need to consolidate or sell or go find investors. So that's probably problematic. And even though the rules don't take effect until the end of this year, I think it's pretty clear that you couldn't issue a CLO today unless you were already conforming to those. So I think the biggest challenge that we have is that all the different pieces of the credit market are unstable. And I think you're going to see spreads begin to widen if you look out over the next 6 to 12 to 24 months.
And Mike, are you seeing similar trends?
Yeah, just from a basic bullet point perspective on current trends that we're seeing on the deals that we're working on, highly competitive lending environment similar to the private equity environment. Highly competitive, still seems to be relatively covenant light from an overall debt perspective. Not totally covenant light, but relatively covenant light, and more of the unitranche lending perspective of trying to be at all parts of the debt on the balance sheet.
Great, thanks. And how has the increasing use of rep and warranty insurance impacted deal making? Tim?
Yeah, I mean, I think certainly in my career, the advent of rep and warranty insurance and the use of it over the last couple of years is probably the biggest change that I've seen in middle market deal activity. A few years ago, it was still relative novelty. To be able to use rep and warranty insurance and effectively be able to give the seller limited post-closing indemnity exposure, or in many cases be able to give them a clean kind of quote public company style deal. These days I think we are seeing it used in well more than half of our deals. And often the private equity groups who are most familiar with this product are being able to use it in many cases to be able to beat a strategic when going up against head-to-head, because strategics haven't fully embraced the product yet. They're trying to get up to speed, and they're actually giving a lot of, trying to educate them. And I think the biggest part of our job is in a process to be able to start educating our strategic buyers early on that this is a product that they can use to help them win the day.
And Mike, what are you seeing in terms of rep and warranty insurance?
More confirmation of what Tim has said. Tim sees this much more than we do on a direct basis, but from our perspective, we're seeing this more and more often as well, where we're getting the calls of, all of our advisors want to look at your reports, our lenders want to look at your reports, give me all the various access letters that we need to have for those various professionals to read our diligence report. And another one that we're seeing more often is the rep and warranty insurance. And can you get on a call with them to answer some questions as well? So just more confirming that it is becoming more normal, not 100%, but more normal to have that in play in the middle market.
And Mark, are you seeing the same generalized use?
Yeah, we were early adopters of this product because we thought it would be very applicable in our business. And we thought it was a great competitive advantage for the last several years. As it becomes more and more common, it becomes less and less of an advantage. But particularly if you go down to the lower end in the middle market, you're dealing with sellers who aren't in the business of buying and selling companies. They're selling the one company they have. And they may not have lawyers and advisors who are all that sophisticated either. So they don't have a good sense of what the norm in the marketplace is for what a contract should look like. So oftentimes we're able to deal with somewhat unrealistic expectations of what the allocation of risk in a contract is by using rep and warranty insurance. So it clearly has given us an advantage in the marketplace.
Yeah. And I think this is a product that is not, it's not a bull market product. I think this is something that will stick with us because it makes a lot of sense.
Thanks. Mike, what key themes do you expect to see in terms of middle market deal making in 2016?
Sure. I mean, I think some of it is going to be consistent with 2015 in terms of, I think the lending environment is going to be quite consistent to what it was in 15. I think the overall middle market and private equity M&A world is going to be highly competitive, similar to what it was in 2015 as well, although I do think valuations are going to turn down a bit, consistent with what we saw in the third quarter of 2015. But the real thing that I'm interested in is what's going to happen with the energy markets. I think that what happens within energy is going to be a really interesting thing within overall middle market, because no matter what, it impacts, to a small extent, every middle market business, but really just energy businesses overarching especially in the U.S. What is that doing? Because there was a very low level of energy investment from a middle market perspective in 2015. And I think as you see things to start to get a little bit better over the next quarter or so, there's a lot of dry powder, a lot of capital on the sidelines, patiently waiting to be put to work from an energy-specific fund perspective. And I think that's going to be really an interesting thing for 2016.
And Tim, what themes do you expect to see emerge?
Yeah, I mean, I think a lot of that same stuff. I mean, I think if we look at our backlog going into next year, in terms of number of deals, the two groups that have kind of the most deals in the backlog are consumer and healthcare, which I think is kind of indicative of an overall health and wellness trend that we're seeing in the country in general, and is driving some deal making.
Thanks. And Tim, I'll stick with you for a second. What challenges, what opportunities do you see private equity facing next year?
Yeah, I mean, I think the biggest challenge, for private equity is kind of given where we are in terms of multiples right now, and being a turn and maybe two turns, above norms, is that how are you going to make your return if you're kind of, quote, paying a premium for these companies? So figuring out their angle and to pick their spots where they can really create a difference with the company, as opposed to just being money, investing in the company, riding it out, pay down debt and sell it in 3 to 5 years. Really figuring out how you can affect change with the business. That's the biggest challenge.
And Mark, what do you think private equity is going to face next year?
I happen to agree that is the biggest challenge. I mean, we're in an economic environment where the U.S. economy is okay, but going sideways to a little up. Europe is in a terrible position. Asia is slowing down. And so if you ask yourself, is that an environment that is going to bring, strong earnings growth? It doesn't really feel like that's a great environment. And yet at the same time, as Tim is saying, multiples are at an all-time high. And then you have to overlay that Tim's talking about multiple compression over the next year or so. But if you buy a company in the private equity business, you're probably not coming out for another 3 to 5 years. So if I look at where we are in the interest rate cycle with basically zero interest rates, and we can all have a spirited debate about when the Fed will start to raise interest rates, but I don't think we're going to have much of a debate about whether it's going to start to raise interest rates. So if I'm looking 3 to 5 years out, and I think interest rates will be significantly higher than they are today, there's no way these multiples hold up. And we're very cautious on what we'll pay as a multiple on the way in, because we think it's next to impossible to have a good fund if you suffer significant multiple compression.
Yeah, I think many of our clients, when they're doing their models, they are modeling in at least a turn of compression on their exit, just for prudence.
And Mike, your thoughts on challenges that private equity will face, and opportunities as well?
Yes, I was going to say probably nothing additional to add on the challenges side, because I agree wholeheartedly with that. I mean, from an opportunity side, we really have 3 types of clients when it comes to private equity. One is it's typically on the consumer side. Truly, they can get into this middle market business and they can affect change on the top line. They have additional sales distribution partners that they can get into different geographic regions, et cetera, really moving the top line and seeing that operating leverage benefit from that. The second is, let's call it just a general financial investor, where they're pretty hands-off. The third is one who's really operational focused, and this is what Tim was mentioning earlier as well, when they're really focused on people, process, technology. How can we get in from the beginning, before we even acquire this company, we're thinking about the exit, how can we affect change from a people perspective on the management team, from a process perspective to improve gross margins or EBITDA margins, and from a technology perspective of how do we really professionalize this middle market business into being a truly upper middle market or professionalized business from a technology platform perspective. So those that are really operationally focused, I think there's a lot of room for them to improve a lot of these, especially core middle market businesses, and it really just depends on finding the right one from a proprietary deal flow perspective.
I guess it's still a challenge, right, to find the right one. So I know we touched on interest rates, but we'll dig into that one a little bit more. Tim, how will a rise in interest rates affect the deal-making environment?
Yeah, I mean, I think near term, a quarter point isn't going to make a major impact on today's environment. I think it's more to what Mark's talking about, that over time, and 5 years from now, where will interest rates be? And will likely be much higher than they are today. That will be impacting deal multiples, and how private equity will then factor that into their exit strategy and how they're doing their models.
Mark, any other thoughts on interest rates?
No, I agree that the short-term impact, particularly since most of our loans are working with LIBOR floors, the first 70 basis points or so of short-term interest rate rise doesn't really affect our borrowing costs much. So I don't think that's really going to impact it short-term. We talked about long-term multiples. I do think that the other impact may be when people go to finance deals or when people look to finance the deals that people are selling a couple years from now, with absolute interest rates higher, fixed charges are going to be lower, and you could see less leverage in the marketplace just because if the cash is going to pay interest, it's not being reinvested in the business. Fundamentally, there's just value going out of the system.
Mike, any thoughts on interest rates?
Similar statements. I really don't think it's going to have much of an impact in the near term with this level of increase, but there's a lot to think about from a 6 to 12 and 12 to 18 month perspective.
Okay, thanks. So 2016 is an election year here in the States. How will the presidential election impact deal activity? Tim?
Yeah, I mean, I think a lot of things in the political environment, what really impacts is the uncertainty and creating volatility. I think businesses and investors are good at figuring out how to do well once they know what the playing field looks like. So I think if there is uncertainty of which party will hold office, then I think there will be maybe a little bit of a wait and see attitude. One thing though will be around taxes, and I think we've seen this in a couple of times previously when there was an expectation that taxes would go up. You saw deal activity go through the roof while people tried to get ahead of tax increases. I think if the Republicans get into control and there's an expectation that there will be a decrease in taxes, you may see people put the brake on doing deals for a little while until they can realize lower taxes. So I think that's one thing that could impact.
Thanks. Mike?
Yeah, no. I'm going to stay away from that one, I think, because
You don't want to endorse a candidate?
I don't want to endorse any candidates, no. But I think the most interesting thing is on the tax side. I think from an overarching, various candidates being especially good or bad for private equity or the middle market is kind of a tough one at this point. But I think the uncertainty real aspect is the one thing that people will be watching, keeping an eye on.
Well, Mike, a little less politically controversial, perhaps. So in which sectors do you expect them to see the most robust deal activity next year?
Yeah, I really think adding on to 2015, healthcare and technology will really see an increase, continued increase in activity. Healthcare is an interesting one because, whether it's because of ACA or just an overall being highly fragmented from a business perspective, and there's a lot of vertical integration type of plays to get throughout the value stream of the healthcare provider. Yeah, I think that's one that's going to really drive the healthcare side of things. Technology, there's a lot of disruptive technologies that have come out in the past 1 to 2 years. I think that's going to continue. And I think there's a lot of middle market providers that support those disruptive technologies and or compete with those disruptive technologies. And as I mentioned earlier, I'm really interested to see about energy. I don't think energy is going to overtake healthcare or technology from an overall middle market deal volume perspective, but I do think it'll be substantially higher than 2015.
And Tim, what sectors do you think you'll see activity in?
I'd agree. Healthcare, technology, and consumer are the areas where we probably have the most robust backlog right now.
And Tim, in terms of the types of drum, Mark, did you have a comment on that?
Yeah, I would comment that a lot of the activity is going to be driven in sectors where the markets and the customers are really changing. And technology was used to be its own sort of separate industry, now infects almost every industry. And so what we're seeing is if you have, particularly at the lower end of the middle market, where we typically buy from entrepreneurs, you can have a person with a wonderful company, but his market is changing dramatically. And I do think that you may see a lot of those people decide that if they're approaching 70, maybe this isn't the time in their life to make all of the investments in technology to keep up with where their industry is going. So maybe this is a good time to sell. And so within our industry verticals, we look for those periods of disruption, which thankfully in this marketplace are pretty plentiful, and say, are there investment themes where we can buy very good companies, buy the market position, but rebuild their IT infrastructure from the ground up to make it scalable and to really position it for where the world is going. And I think that's going to be a continuing underpinning of a lot of entrepreneurs selling over the next couple of years.
So in terms of the types of transactions, Tim, are you seeing more platform deals than add-ons or the reverse?
Yeah, I mean, I think in our business, almost by definition, most of the time it's going to be platform deals that we're selling. So I'd say my view is going to be a little bit skewed, by that. But look, I mean, when a private equity firm buys a platform, they all have an acquisition thesis that's associated with making their platform acquisition, and are looking to try to do within the first 1 to 3 years, one or more add-on acquisitions to be able to grow the business, create synergies, and make it more attractive, hopefully for a strategic buyer.
And Mike, are you seeing more add-ons or platform deals?
We saw a significant increase in add-on activity in 2015, especially when you're looking at those private equity firms in the, call it $750 million to $1.5 billion under management. They're buying these really nice platform companies, but then leveraging down their overall multiple paid, quote unquote, for the business by doing a substantial buy and build kind of program where they're doing a lot of add-on transactions at lower multiples than what they acquired the original platform company for. And that brings a whole slew of other kind of merger integration and overall operational kind of improvements that come to play with properly integrating all of those add-on acquisitions. But we saw a significant increase in add-on activity primarily because of that.
You guys touch on strategic versus financial differences in add-ons versus platforms. When a company's running an auction process, as an acquirer, who has the most significant advantages? Is it strategic or is it a financial acquirer? Tim?
That's interesting. If you have a good strategic, they should be able to win all the time, but they don't. And there's a lot of reasons why. And I think when we are advising a client and they want to make sure that they get a deal done, our advice is always, look, you got to include both strategics as well as financial buyers. I mean, if you think about it, it makes sense, right? A strategic buyer, they are in the business of doing whatever they're in the business of doing, whether it's an insurance company, whether it is a food manufacturer, whatever, they're in the business of doing that. And M&A is part of their strategy, whereas private equity groups, they're in the business of doing deals. And so, strategic buyers can get distracted and not do a deal for any number of reasons. So I think, look, when we see our long-term average, at Harris Williams, we're probably selling in the range of 50-50 to strategics versus financials, and it kind of ebbs and flows between 60-40 going either way. So in general, about 50-50, but private equity has done a real nice job of figuring out how they can compete with the strategic. In current interest rate environments, the amount of capital that's available, they can compete on price. And then they're doing other things like rep and warranty insurance that we talked about earlier to help differentiate themselves versus a strategic buyer. I sold the deal earlier this year where private equity went head to head with the most logical strategic and just flat out beat them.
Mike, your thoughts on who has the advantage?
I would say the strategics, at least from what we've seen recently, we're seeing a lot of our private equity clients acquire these middle market businesses that are not, I would say, not truly professionalized at the time that they acquire them. But at the time that the private equity firm acquires this business, they have in mind their exit already. And the exit is to a handful of strategics. And because of that, at the time that they acquire this business, they, at the period of ownership, that 3 to 5 years, they're doing everything that they can to increase the right sales channels, distribution channels, geographies, and to professionalize the business to be a more likely candidate to be sold to the strategics, although they already have the strategics typically picked out at the time that they purchased the business. So it's a slightly different answer to your question than just a broad auction process, but that's the main thing that we're seeing in the current day.
And Mark, where do you see the advantage?
Well, I think generally when you're talking about deals that are several $100 million and up, I completely agree with what both of these two guys are saying, which is generally the strategic guy should have the advantage. It's interesting when you go below that and you're talking about owner-entrepreneurs and what their priorities are in life. And what we see is that if you have somebody who's built up his own business from the beginning and it's now worth $100 million, he might have a son and a daughter, but this is actually the third kid. And they really care who's going to buy it. And some of them don't like some of the people that they compete against. And so what you find is price is not unimportant, but it's not the most important thing. So we look across our portfolio right now, and we have 4 companies so far in our newest fund. We weren't the high bidder in any one of those. And that's because there was a combination of they wanted to keep some equity in the business and see it go forward. They responded to us as partners and our industry knowledge and what we might be able to do with it. And candidly, we were just easier to deal with, and they felt that their legacy would continue as opposed to get absorbed into a much larger corporation and disappear.
Interesting, an emotional component to the process, which I wasn't
Yes.
expecting to hear. So we touched on the Affordable Care Act a couple of times, I think, previously, but what impact has the Affordable Care Act had on non-healthcare related deals? Tim?
Yeah, I do quite a bit in the restaurant and the retail space, and 2-3 years ago, Affordable Care Act was like one of the #1 diligence items that people had to get their arms around. And frankly, there was a lot of uncertainty of what the impact actually was going to be, so nobody really knew how to price it. I think today people have kind of figured out what the impact will be on companies' financial statements, and so as a result, it has become less of a diligence item, and people have been able to price the impact of it.
Yeah, Mike, where are you seeing have an impact?
I think that's true in the core middle market and the upper middle market. In the lower middle market, we're seeing it still as an issue, especially with businesses with a substantial amount of part-time employees, or just lower middle market businesses that don't have healthcare plans in general terms. We're still seeing it as, when we're going in to do the diligence on the buy side, that they thought about it, but they're kind of waiting for this process to start, and then they can gently discuss it with the buyer and whatnot, and they haven't engaged professional advisors to just figure it out for themselves. And that's what we would just recommend. It's not a huge gating item anymore, because to Tim's point, everyone kind of knows what the impact is going to be. You just need to know how to implement it and know how much it's going to cost to implement. And having that done with a professional advisor for that target company before going to potential acquirers saves a lot of time and effort during the diligence process.
Thanks. And Mike, what trends are you seeing on cross-border transactions?
We're seeing a substantial increase in cross-border transactions, which is interesting because a lot toward Europe, a lot toward Latin America, but it's typically with firms who I would say almost specialize in those areas. I don't think we're getting a generic, typically North American, typically U.S. private equity firm going out there to seek additional yield. I think that most investors still believe that the middle market U.S. The U.S. middle market company is still providing a better value and better higher upside than across the globe. But we are seeing, with all that said, we are seeing an uptick in cross-border deals. And one of the more interesting things that we're seeing is, let's say a U.S.-based company acquiring a business in Canada. We've seen 4 of these in the past 12 months. But that Canadian business had substantial sales in the U.S. And it brings a whole nother situation to analyze, both from a buyer and advisor perspective, because we're seeing all these businesses that are headquartered and primary operations are based in Canada. More than 50% of their sales are in the U.S. And you have this very interesting dynamic over the past 12 to 18 months of the strengthening of the U.S. dollar. So you're seeing sometimes it's very small impact, sometimes it's substantial, of what is the foreign currency impact on the financial statements, and then breaking that down into what is the true cash impact of that on the financial statements, and what's the non-cash impact of that of the financial statements. And then somebody's got to figure out how to forecast where it's going to go, which is where I stop my analysis.
and that's huge, because if you're a private equity buyer trying to do that, and what is your EBITDA going to be in 5 years, when inevitably the dollar will weaken against the Canadian dollar, that's a huge issue.
Mark, what other challenges do you see private equity facing in cross-border deals?
So, and we've done several what we think of as small multinationals and a couple of cross-border deals. Years ago, I bought IMAX, which was a Canadian company. We bought a company called Moravia, who's technically headquartered in the Czech Republic. But generally, we're always looking for a significant locus in the United States because that's the market we know best. Having said that, when you are looking at somebody headquartered outside the U.S., even if you're comfortable with the business analysis because of the U.S. angle, the fact is doing due diligence will be twice as expensive, and a lot of the tools and resources you rely on either don't exist or they aren't handy for you at that moment. So you have to develop a network of resources around the globe that can help you vet those individual markets. The second thing you get into is both legal structure and legal liability. Having employees in the United States is very different than having employees in China versus Argentina versus the Czech Republic. So, and we actually have employees in all of those places, and you go at your own peril if you don't understand the differences. There's tax structure. You would think that by now it shouldn't be that hard, but literally we have teams of lawyers going through the intricacies of different tax treaties and therefore to construct a tax structure that makes sense. And lastly, currency, which is a big deal because we've seen a degree of volatility in currency. We own AT Cross and Schaefer pens, and roughly 2/3 of the sales are outside the United States. Well, Japan is a very big market for us. Since we bought it, the yen has gone from 90 to 125. You look at where the euro is, and it's down at like 107 today. It was at 125. So you have to rebalance how you run the businesses and try to match revenues and costs. And you hedge where you can, but you can't hedge away these risks. So you really do have to be very thoughtful about where your costs are and how do you manage your costs as currencies shift.
Mike, I know that's a long list of challenges. I don't know if you're seeing other ones for private equity to contend with in cross-border deals.
Yeah, I just want to add on to the foreign currency point too, because I think it's just a really interesting dynamic. I've seen it so much over the past 12 months. We've actually started working with a foreign currency optimization consulting firm who actually does a lot of this from both a cash repatriation issue as well as a overall hedging, as overall how much is actually costing you to do all these transactions. And I just think that it's amazing because we go into these businesses and here's what all the historicals look like, but on like a daily basis, how do you mitigate all these risks from an FX perspective? And some of it's real cash. So I just think that that's even going to continue to be more and more important for private equity buyers of these multinational, especially middle market, lower middle market, but multinational businesses. From another challenge perspective, I would just say, to add on to what Mark said earlier, really having that deep expertise in the region that you're investing in is so important. We were talking earlier on some of the places where Mark has invested in the past, and every place is so different from a geopolitical standpoint, from a tax standpoint, from a personnel standpoint, and really engaging with advisors in those regions who have experience on the ground is very important as well throughout these processes.
Thanks, Mike. Earlier you referenced the general strong performance of middle market companies in the U.S., but are there other areas of the globe that you see as attractive for investors?
Some of our clients have interest in Europe. We've done a lot of deals in Europe recently. We have a lot that are interested in Latin America, South America, some that are trying to dabble in Asia, but they haven't really totally figured it out yet. And with all that said, I think it's a little bit of a diversification play and that they are international type funds, but at the same time, they still, as of now, believe that U.S. middle market is going to provide greater value over the term that they're looking at as compared to looking to some of these other locations internationally.
Mark, are there areas outside of the U.S. that you think are attractive for investors?
Well, we actually don't think any of the areas are as attractive as in the United States, just on a macro basis. And you can make an argument for some of the markets perhaps still, despite much lower growth rates, still being places where you might find opportunity. A market like China, its growth rate is going to slow, but it's still growing probably faster than the United States. For most U.S. funds, I think they would find that that opportunity probably will be taken advantage of better by local investors than it is by foreign funds. So we're delighted when our businesses expand into these territories and grow their businesses in a very international way. But in terms of where we'd see a focus, given opportunity and given who we are, it's really in the United States.
Thanks. One more question, then we'll open it up for questions to come in from the audience. In terms of fundraising, how does this year compare to last year, and what do you expect to see in 2016? Tim?
Yeah, I mean, I think this year compared to last year, I think fundraising is a little down, but not materially so. So I would kind of call it flat. And I'd say the fundraising environment is pretty good right now. I think the macro numbers are saying, like I said, basically flat to a little bit down. And when I just look at anecdotally, some of our private equity clients who are out there fundraising right now, they're being met with a good amount of success.
Thanks. Mark?
So I think a part of it depends who you are and what part of the market you're in, because there's clearly a lot of liquidity out there. So there's a lot of people who want to invest in private equity. When you talk to large pools of capital, public pension plans, sovereign wealth funds, and you talk to their consultants, they're all being told to narrow down dramatically the range of relationships that they had. That they've been told they've bought the market because they have too many funds, and they should narrow it down and have deeper relationships. So I think if you are a mega fund, while I'm not sure the highest returns are at that end of the market, I think a well-performing mega fund, this is just a fabulous fundraising environment. For smaller funds, for much smaller funds, what you see is that these same people will take a chunk of capital and they'll give it to an advisor to put together a portfolio of smaller, GPs. And we can do well in that kind of environment. Where I would have the most caution is for those people in between, because as they shrink the relationships, they're basically, and saying, I want to go from having $100 million into somebody 250, they're basically taking themselves out of the market for a $1.5 billion to $2 billion fund, because it'll be too high a percentage for most of them. So I think in general, you'll see aggregate numbers that are very good, but I think it will matter a whole lot which end of the market you're in.
Mike, what do you think next year holds for fundraising?
Yeah, I think when we finish out 2015, when we get the final stats on fundraising, I do think actually that 2015 is going to be one of the best fundraising periods that we've seen in a long time. The first 3 quarters show that, and I think if we end with the fourth quarter being a good fundraising quarter as well, I think 2015 is going to be the one overall fundraising years in a long time. I think 2016 is going to be an interesting time because I think there's going to be a lot of momentum from the 2015 fundraising, but at the same time, there's so many funds that we're able to close within 2015, they're going to be putting it to work for the most part. So 2016 might see a little bit of a slowdown, but I think it's going to be still a very healthy environment and more lead to what Mark was saying earlier. I know that I talked to 2 of my clients recently that are in the $250 to $1 billion range in terms of fund size, and it's their second and third funds. And both of them were oversubscribed, stopped it at a hard cap, and one has already closed and one will be closing shortly. And I think that they had thought that the fundraising environment was quite good for that middle market private equity firm in that fund size range.
Great, thanks. Well, we have some questions coming in from the audience. So if rates rise as expected, what would you expect to see on deal size and EBITDA multiples going down? I don't know which one of you guys would like to put his hand up for that.
Yeah, I mean, I think my personal view is if we, kind of near term, small to modest rate increase won't, have a material impact on valuations today. I think it's really more about the longer term.
Any other comment from?
I think we talked about it. I think the longer term multiples are going to have to come down as long-term interest rates rise.
Tim, a question for you. Which subsectors in the food and beverage space will see plenty of deal activity in 2016?
Yeah, I mean, just going to be good for you. Natural, organic, better for you, functional products. I think everybody is trying to figure out a way to eat more healthfully. And so any way you can even have an angle for better for you products is going to attract a lot of attention. And that I think also, kind of specialty products, perimeter of the things that you find in the perimeter of your grocery store are also going to be, kind of more premium. They will also attract a lot of attention.
I think the next question you touched on already. So how focused will private equity be on big data and analytics in 2016?
I'll be happy to talk about that because it's actually a place where we spend a lot of time. I don't know that except for those folks who specialize in tech investing that they'll invest in, quote, big data companies. In other words, the actual providers of that. But what I do think is that if you look across almost every sector, if there is an availability of data, what you're seeing is just a complete evolution in how people analyze who their customers are, their customers' activity, and how do they maximize the value of their business. And the systems and the analytics are way behind the reality at this point for all but the largest companies. But like most things, that'll tend to trickle down over time. And so what we're seeing is that for businesses that have direct contact with their consumer, so those might be online businesses or direct marketing businesses, we're seeing an applicability much early on because they have the data set. And you find some very surprising things. Some fine companies, well-run, very data-driven, but if you take a step back and you look at every transaction with every customer over a period of time, sometimes you find out that the lifetime value of the customer is actually much higher than they think it is, because there's a very interesting dynamic when you look at data sets, which is that people tend to look at averages. Who's my average customer? What's the average order size? How often do they actually order from me? If you make that much more granular and you look at us and you plot, a spectrum so that you say how many of my customers order from me daily, weekly, yearly, and you do that curve, and what are the average sizes, and you begin to analyze that, you find out that your best customers may be worth a lot more than you realized, and that you want to run your business in a different way. So I think we're at the very beginning of a profound change in the way companies are managed, and I think it's going to impact things dramatically.
Thanks. Does the panel see the private equity space becoming securitized as private equity firms acquire and sell from other private equity firms on a consistent basis? So, panel?
Somebody want to define the question?
Yeah. I don't know that exactly what they're trying to get at in terms of the question, but I don't see that. In terms of private equity sales to private equity secondary buyouts, that we are seeing a lot of that. We're also seeing a lot of private equity to strategic buyouts. But in terms of securitization of almost more fund to funds out there, I don't see that being a dramatic trend in the business necessarily.
I think we are seeing a lot of private equity to private equity sales for sure, and I think that is not as discouraged as it was maybe 10 years ago. But I think one of the things that we've observed in private equity is that different funds have figured out how they can have their comparative advantage. So you've got a fund who knows how to buy a small family-owned business and then professionalize it. They maybe sell it to another fund who knows how to penetrate markets a bit better. Maybe then they sell it to another fund that knows how to take advantage of international opportunities. So as I think funds have become more sophisticated and figured out how they can be more value add, it is just natural to be able to have more private equity to private equity sales.
Have you been seeing more dual track processes?
Some. Right now, when the equity markets are going well, then you'll see a bit more dual track processes. I think people believe that that's a way to help increase the multiple, if you will, to have that other kind of competitive dynamic out there. I would say, from our perspective, from Harris Williams' perspective, it is definitely the minority of deals that we work on.
So last question, guys. What do you see as the opportunity for first-time funds in the next year?
I'm happy to take that. I think it's actually sort of sad. It's becoming harder and harder to start a fund, and it's becoming a lot more costly. And since most people start out their businesses with just a handful of people, now you have to register with the SEC. You have to put into place all of the compliance attached to that. The level of reporting and the granularity of that for your investors has gone way up. They haven't consolidated that, if you want, or homogenized it into a single reporting format. So we'll report the same information to 5 different LPs who are large in very different ways. So you now have to have a financial staff that can do that. So I think it's actually unfortunate, but the economies of scale, the minimum threshold to actually have a viable business, it's become much harder.
Mark, thanks. And gentlemen, thanks so much for joining today.
Thank you.
Thank
I've
you.
been speaking with Mike Finelli of RSM, Tim Alexander of Harris Williams, and Mark Ute of Clarion Capital Partners. Thanks for joining.